because important things, and I like to make my point. So just to clear that up. So we've got a lot to discuss today. Take some good notes. At the end, we're going to have a Q&A session. Also, I've only got about an hour or so. At the end, when we're done here today, if you want more help, I'm going to tell you where you can go to get more help. Okay, so if that sounds good, I'm going to start by asking you guys a question. What's the hardest part about preparing for retirement or being retired? What's the hardest part right now? If you could type your answer in the chat box. And again, the chat box, remember, is going to be located in the control panel on your GoToWebinar screen there. You should be able to find that. Okay, if you could type that in, great. Okay, here they come. Enough income, Stephen says. Salim says planning. William also says income, keeping busy with goals, knowing how much you might need. Yeah, that's a big thing when it comes to planning. Money management, David says, and that's a big one here, how we manage these retirement portfolios. Richard says not enough hours in the day, so maybe it takes too much time. Yeah, that's an important factor here as well. Steve also says determining how much I'm going to need. Yeah, all of these things come into play. So getting a good return on capital, not spending too much. Yeah, that's an important one too. It's hard to do. And Greg, I like that one. Trusting. Greg's got a great one here. One of the hard things about preparing for retirement is trusting that you know what you're doing, that you're confident in whatever plan you put forward. And that's a really big one, Greg. I'm glad you typed that one in. And Peter, along those lines, keeping your sense of purpose. Okay, well, from all of those answers that I'm seeing there, it really does sound to me that you guys are in the right spot today, because we're going to address a lot of those concerns, frustrations, those issues that you have, and we're going to set you on the right course, I think. So let's go ahead and get to it. If you are able to, if you've got a pen and paper in front of you, a notebook of some sort, I want you to take a moment and see if you can draw this diagram out with me, because it's going to be important. I want you to walk through this, because a big part of building, managing, and preparing for retirement, again, is having objectives and plans on how to move forward. So again, I want you to have a retirement that gives you the peace of mind. And what we mean by that, it gives you enough money, right? We want peace of mind. That's our ultimate goal. The plan is going to give you enough money to do the things you want to do. It's going to give you the time to do the things that you want to do. And then, as we just talked about, it's going to give you the confidence that you can handle any situation that the market throws at you. Okay, that's going to be our goal here. Those are three key aspects to building that secure retirement. So to do that, we believe there are three parts of your investing that we need to focus on. And number one is going to be the profit side, as we continue to fill in our diagram here. The way we profit, in other words, the way we grow our capital, that capital appreciation and the growth that we look for. That's where we primarily focus on strategies to make money when the market's going up or going down. Think of this as simply growing your retirement portfolio. So it's that capital appreciation aspect of your portfolio. Secondly, we need to focus on the way to provide income, right? We need that steady income on top of that longer term growth that we're looking for. So while we're growing our portfolio, we want a steady cash flow that we can build. We really don't want to always be dipping into that main account to pay the bills or take a vacation or whatever we might do with that. We want another source for that. Okay, and that's where we provide, and that's for the income portion of what we're talking about here. And then last, but certainly not least, and one that is most important to me, is preservation or preserving, right? Perhaps the most important piece of what we're going to talk about is preserving what you have, right? Protecting that retirement nest egg. We want to make sure that any loss we take is minimized, because there will be market drawdowns as we've witnessed, at the end of 2018 from October through the end of the year, right? There are going to be drawdowns, but we want to mitigate, eliminate best we can any of those drastic drawdowns. And everything that we're going to do is going to have minimal risk and we know how to protect ourselves once that is in place. So profit, provide, and preserve. Those are the three key aspects that we want to focus on. Now, to take this a step further, to do this, there really are 9 techniques that the very most successful retiree will use, that they have at their disposal, right? We're not going to master all 9 of these today. What we're going to do is talk about them and, again, cut through the noise and show you what you need to get started in doing this. So I want to lay out here that map, and then I'm going to give you that shortcut. So when we start with the profit side, okay, using stocks, ETFs, we're going to primarily focus on stocks in our talk today, but ETFs are part of that. We're able to use those in both up and down markets, but also, they can work. A lot of ETFs will help minimize losses in a downward trending market too. So we're going to talk about stocks. That's one way to do it. The most successful retirees also have at least a basic understanding of option calls and put options. We're not going to get too deep into an options related course here, but just know that they're out there to help out. Okay. And then once the ideal retirement package is mastered, right, then take the option side of that even further, and we have multi-leg options there. Okay, that's the profit side. When it comes to provide, there are certain pieces of the puzzle that we need to focus on here as well. And making sure we have a plan to capitalize on dividends is number one, right? That's the simplest way to generate income in your portfolio. After that comes covered calls, right? Selling a call option. I'm going to talk more about that in a moment, but covered calls is another great way to generate even more income on top of the dividends in your portfolio, right? And once we have that under our belt, again, the most successful retiree will have the credit spreads where you actually get paid to sell options. But again, this is the entire package we're talking about here. Finally, preservation. When we talk about preservation, one of the key words you'll hear often that we'll use is hedging, right? When you hedge your portfolio, it's just another way of saying that I'm protecting my nest egg when the market is moving against me. When there's uncertainty in the market, a nervous, toppy market, I have to be proactive, right, to preserve my portfolio. So hedging is a way to do that. To do that, we use, again, put options. We combine those with a covered call. That's what a collar trade is. And then lastly, there's trade repair techniques that we can go through. All right. So these are all of the things. There are a total of 9 things here that you can do. My promise was to walk through that and take away some of the noise there. If you were able to go through this and draw it out, as I mentioned earlier, what I want you to do is just take 10 seconds. Don't overanalyze this. I want you to put a check mark next to the part of your system where things are all good or going well for you. If you have any of these in place, or maybe if you don't have them in place, go ahead and put an X mark or a little frowny face next to it. Put a smile face or a check mark towards those that might be working well for you, right? So again, don't overthink it. Take a minute and go ahead and do that. And what we want to be able to do there is focus on those so that we can put the odds in your favor, where you can say positively that you have the ability to achieve that peace of mind in retirement. So as you're doing that, in the chat box, I want you to let me know, based on that, how close is your system to peace of mind? So if it's easier for you, you can type in a rating out of 9. Say, for example, if you had 9 check marks, you'd have 9 out of 9. That would be great. You're in perfect position. If you've got just 3 or 4 of these down, go ahead and write 4. Far away. Someone who wrote in there, Tom said far away. 2 out of 9. 8 and 5. 3 or 4 out of 9. 2 out of 9. Gail and Nick said they have 8 of those. Well, that's fantastic. That's what we're looking to do. Bob says he's got about half of them done. A lot of folks are in the 4 or under number there. Okay, yeah, and a lot more are coming in. 3 out of 9, 2 out of 9, yeah. And Bill, Bill, again, that's why we're here today. Bill says he understands the concepts, but sometimes struggles with the implementation. Okay. What we want to do here, if we look at this, all of these 9 things are great, but it's hard to jump into some of these: trade repair, hedging, multi-leg option trades. If we had to shortcut this, there are a few that we'd focus on first, and these are the concepts we believe that you must have. Okay, so we're going to kind of cut, like I said, cut through some of this noise. Number 1, we need to have a profit plan using stocks to grow our portfolio. Okay, so that's number 1. Number 2 is we need to look to provide that income I talked about, how to generate that steady income. We're going to focus here on dividends and covered calls. And then lastly, we need to preserve our capital. And here we'll focus on a trade everyone can do to protect against big losses. We're going to look at protective puts. The goal here, if you are not an options trader or familiar with options, the goal here for our purposes in these key concepts is not to turn you into an options trader. It is my strong belief that to build and manage your retirement nest egg, that you need to understand 2 option trades. One of them is the covered call, and the other is the protective put option. Okay, we're going to do those today. That's our plan. If you're okay with that, type it in. Let me know you're ready to go, and let's move on. All right. We're going to start with the profit side. Looks like everyone's ready to go. We're going to start with the profit side. Again, we've got stocks and there's ETFs. There's so many ETFs out there now. We're going to focus once again primarily on stocks today. So we're going to look at how to find the right stocks at the right time. It all begins with safety, right? Play it safe. That's the most important part. So in other words, for our retirement account, primarily our growth portfolio, we want to look at companies that are more safe than anything else, right? We don't want to go out there trying to choose stocks where we can hit the home run, right? The old baseball analogy, which I'll use more than a few times here throughout the day. It's fun to go out and hit the home run. We all love the home run hitter. But I'll ask you guys, what happens, for those who follow baseball, what happens to most home run hitters when they don't hit a home run? There's a few exceptions, but what do? Right? Hardy's going Red Sox. Yeah, they strike out, right? Oftentimes. The home run hitters strike out. Well, we don't want that in our retirement portfolio. We don't want to take that big swing and miss because that's not what this account is all about. That's not what building and managing a retirement portfolio is about. So safety first is the key, because what happens if you forget your objectives, if you forget what concepts you're trying to put into place, you end up building a portfolio that's totally different than the one you need to meet those objectives. And you start to begin to invest like someone you're not, or at least you're investing like someone who's not following the objectives that they set out for in the beginning, which is preservation of capital, then growing that capital, and then adding that steady income from there. Okay, so that's an important part. Now, what happens is that people start not seeing the returns that they want, and they'll start swinging even harder. And the answer is always not to go faster, right? Don't try to become a day trader or a short-term trader to try to make money back quickly that you might have lost in the market, right? I have 2 boys. When I was teaching them how to drive, if they were struggling, and I'm sure a lot of you folks can relate to this, you didn't stand there or sit next to them and say, you know what, you're having a hard time, go ahead and slam down the gas pedal, right? Go faster, everything will work out better. That's not what you would do, right? I told them to slow down, take your time, right? We're going to do the same thing in our retirement portfolio. And all of this begins with a quote from our founder, Dr. Bart DeLito. And he said that good portfolio management starts with buying the right stocks, right? And again, I'll use my baseball analogy as spring training begins. right? The New York 1927 New York Yankees, arguably one of the greatest sports teams ever. I liken the idea of building your portfolio as to your baseball roster, right? You have a roster, you have your team on the field, you put the very best players on the field. That's who wins, right? And whoever typed in the Red Sox, Jay said the Mets. Unfortunately, I'm a Mets fan, and recently things have been a little tough. But that's the idea, starting with the right stocks. So we want the right players on the field. So what I want to do now to accomplish that is to begin to train your eyes to look at a graph, and just by seeing the movement and the history of a stock, we can start to determine what a safe stock looks like. So much like you would at the eye doctor, I want you to go through these, and I want you to determine which looks better, A or B, right? So if we look at Fossil Inc., we look at a graph. Up top is the price of the stock represented in candlesticks. Down below is the earnings per share that we calculate in VectorVest, and that's where the earnings growth is going, right? Just to set you up for the next few slides that we're going to have. So this is the movement of the price. This is the movement of the earnings per share on the stock. So which looks better to you, A or B? Right here, we've got that lower left to upper right pattern. Down below, these are 5-year lookbacks, by the way. These are 5-year graphs of these underlying stocks. So which looks better? Everyone's typing in B. Very good. With exclamation points even from William. Yeah. Which looks better? Tupperware, TUP, or Visa over the last 5 years? A or B? Which looks better? B. Right? Clovis Oncology, CLVS. Which looks better, A or B? Right, B does, right? Why? Because it's got that slow, steady move from the lower left to upper right, and we'll look at a couple of more. Here's one, UBX, right? No data even exists. It's less than a year old, this stock. It's a volatile stock. Which looks better, A, or when you compare it to a company like Rollins Inc. over a 5-year period? Which looks better, right? B. So you see a pattern there. And what I want to get across as we look at this, when we look at stocks like this, just let me be clear. It is not a coincidence that as earnings per share continues to grow, so too does the price of the stock, right? The stock will continue. Now, does it have its ups and downs? Every stock graph, every equity curve we look at from October of 2018 through the end of the year is going to have this drawdown. The market sold off violently in a roughly 90-day span. But overall, over time, and that's what we care about. This is a 5-year look. That's what we're looking for in a stock. Same thing here, A or B. It's going to be B once again. So we see the pattern there. And that's going to be very important. So when we talk about stock safety, we know, and Dr. D has taught us, that earnings is what drives the market. It's what drives the individual stocks. So when we talk about safety, right? When we talk about safety, all of those stocks had one thing in common, right? The safe stocks, the stocks that were rising. All of those had that were labeled B passed what we call our safety stock safety checklist, right? The stocks whose prices were falling and earnings were falling, they did not pass that checklist. So what is on that checklist? What do we look for when we talk about stock safety? Well, first and foremost, we're looking at earnings consistency. Does the company make money quarter over quarter, year over year? We look at the company size. Now, it's important to understand that just because a company is large doesn't mean it's safe. But we do take that into account when we look at the information that we need to know if a stock in the longer term is going to be safe. We look at price behavior. Again, those graphs we looked at were 5-year graphs, right? I could have gone back even further, and many of those stocks would have had that same smooth pattern. We want to take into account how long has the company been in business, right? Not that a company that's been around for 3 or 4 or 5 years can't be a good company and a growing company. That's not the point, right? But when we're talking about a long-term prudent/conservative portfolio that we're building, we favor companies that have been around a bit longer. And that segues into the dividend history. Dividend history, a good quality safe stock doesn't necessarily have to pay a dividend. But here's the key to remember. When you're buying a stock for your retirement portfolio that does pay a dividend, we have to be absolutely sure that that dividend continues to grow. Not only that they pay it, but it continues to grow. Because the last thing that you want to see on a dividend paying stock in your portfolio is a company that has to cut or eliminate their dividends. There's not a greater black eye for some of these companies if they go in and they have to start cutting dividends. It's a terrible idea that, you know, the company is not generating the income, doesn't have that free cash flow to continue to pay. So dividend history is a big part of what we're looking for. And then finally, debt to equity ratio. It's just balance sheet stuff. How much does the company owe versus what they have or what they own? Why is that important? Because every company, the economy, or every company at some point is going to hit some headwinds. And the key to a safe company is, how are they going to be able to handle those headwinds when they come? Are they going to be able to get through the tougher times? So a strong debt to equity ratio is going to be a big part of that. Okay, so those are all very important points. So when I say a safe stock, okay, there's more to it than, you know, just, oh, hey, this one looks safe because it's gone up for a few months, right? We believe there's a lot more to it. Now, if you go out and you try to look up all that on your own, okay, you're just going to get buried in data. I'll tell a real quick story. I was in, well, I'll save that story for a moment because it's a good story, but I'll save it for a second. You're going to get buried by data. What we do here at VectorVest is we have created one single indicator that looks at all of that data, takes into account all of that information that I just talked about. And that indicator that we use here at VectorVest is called relative safety. It's defined as the consistency and predictability of the financial performance of the underlying company. And I always say, what two better adjectives than consistent and predictable are there to have to describe the stocks that are in your retirement portfolio? So relative safety, how do we do that? Well, we make it easy in VectorVest. It's on a 0 to 2 scale. In the VectorVest program, anything below 0.90 we would consider poor, 0 to 0.89. 9 to 1.09 is fair on that 0 to 2 scale. And then finally, anything above 1.1 is good, very good, or up to excellent here. So we have a great way of taking all of that information I just walked through on our stock safety checklist, actually securing those numbers, filtering it in through our program, and laying it out on a very easy scale for you to rank and analyze these stocks. For example, here is one of my favorite searches that we used. It's called ruler stocks. Okay, and this was the story I was going to tell. I wanted to wait till I got to this slide. The story about ruler stocks I like to tell is a long time ago. I don't know, it's got to be 7 or 8 years ago. I was on the road for a seminar for VectorVest, and we were in, I forget where we were, maybe Denver or somewhere. And there was a customer who in the first morning there had come in, and he looked a little like he hadn't slept in a while. He was a little unkept, I guess, and like maybe he had too much coffee. And he kind of came at me before we even got started and threw a piece of paper at me and said, look, before I came to this webcast, this seminar, I have spent hours and hours going through Standard & Poor's and Morningstar and all kinds of different ways to find out things like debt to equity ratio, the balance sheet. Does this company have a free cash flow? Does it have all of this information? And he was really, really on edge. Like I said, like he hadn't slept. So during the first break, I called him over to the computer and I said, listen, give me that list of stocks again. I think there were 8 or 9 stocks on the list. I ran this search called ruler stocks, and 6 of the 8 stocks on his list were in the top 10 of ruler stocks. So with one click of the button, I was able to show him that when you look for stocks with high relative safety, and this is the Unisearch tool in our program. This is our search engine that allows us to find these stocks. This is just one example of a search. Relative safety has to be greater than or equal to 1.4. Remember, that's excellent when we just looked at that scale. So just to make the list, it has to be 1.4. The earnings growth rate, that's earnings growth in percent per year, has to be at least 14%. And then we have some other specific indicators. And then not only that, we're able to sort them by the relative safety ranking times the earnings growth rate to bring the very best to the top. And this is a snapshot from just about a week ago or so. Right, so you see the type of companies that come to the top where relative safety numbers are all very strong, and all of the other numbers that we care about, other fundamental numbers, technical indicators like relative timing, all usually fall into place when we have those high relative safety numbers there. So yeah, 6 of the 8 stocks were in the top 10. I think the other 1 or 2 was like number 11 and 12. And so all we had to do was click a button, and that's the power of relative safety and how it can save you that time. So what we've done using those numbers is we've got a system, growth portfolio. When you focus on high safety stocks, it's a very simple process that we do. We buy high RS stocks when we call it a confirmed up call, right? In the VectorVest system, we have different market timing signals. Our most conservative or prudent signal in the market is called a confirmed call. When that confirmed up call comes, we simply go out and buy high RS or relative safety stocks. If that signal is in a confirmed down, we don't buy. Doesn't necessarily mean we get rid of all the other stocks we own. We just simply don't replace any stocks. Okay, and it simply tells us to stop buying. Now we have other management techniques that we use, and we'll talk more about that, but that's the basic idea of building your portfolio, buying high quality, high relative safety stocks when the market's rising, and simply not replacing or building it when the market is falling. So what happens is when we follow that idea, here's the type of portfolio, our model portfolios that we use, and a lot of historical back testing and actually real portfolios that my own portfolio is one of them, that manage, and you can see that nice, this is about a 6-year look back. This portfolio was begun in January of 2013, right? This is a portfolio of high RS stocks, up over 85%. That does not include all of the stocks in this particular portfolio would pay a dividend. That 85% is all about capital appreciation. And before we're done here today, remember I talked about preserving capital and how important it is. This drawdown occurred from October through December of last year, right? We're going to show you even how to, if not totally eliminate, at least mitigate significantly that drawdown when the market turns against you. Okay, so those are the kind of results we can look for when we look at that. Okay. So when you don't focus on safety, it leads to what we call the portfolio roller coaster ride. Instead, when you focus on safety, you get that nice steady climb. Remember, I said earlier that we want to have that peace of mind when we retire, right? That is the goal here. So this is one piece that allows you to do that because you'll be safely and steadily growing your portfolio over time, right? We don't want the crazy ride here. Right? Which would you rather have? That kind of ride, twisting and turning, ups and downs, or would you rather have that nice steady flow and that growth? You can type it in. Which one would you rather have? I think I know the answer. There you go. Thanks. Tamara, thank you. Yeah, we want the steady ride. Okay, so that's one way to do it, is buying the safe, high safety stocks. The second thing that we're going to focus on is using dividends and covered calls to provide income. Right? This is extremely important as you prepare or enter into retirement. Again, you want to be able to grow the portfolio with capital appreciation, but just as important is that steady flow of income. We can get them from both dividends and covered calls. Whoops, sorry about that. So in other words, we want to get paid. So one of the benefits of focusing on these really safe stocks is that they do typically pay a nice dividend to shareholders. And we want to be able to capitalize on that. and we know everyone understands what a dividend is. They know about dividends that come in, is right. But finding the best dividend paying companies for a lot of people isn't always the easiest things to do. For example, if you Google good dividend stocks, what do you get? About 850,000 results. And what you're going to find when you do this is you'll see the current dividend yield. All you're going to do is get stocks with the highest yield. And one of the biggest mistakes for folks who are going out and buying dividend paying stocks is that they just search for that highest yield without any consideration to how safe that dividend is, how safe the underlying company is, how long they'll be able to pay that dividend. And that's a big mistake that a lot of folks make when looking for dividend paying stocks. You can go in, there's all types of places. There's NASDAQ, you can go to NASDAQ.com, right? You can get the yield, but is the dividend safe? Is the company safe, right? There are several places you can do this. Always sorted or generally sorted with the highest dividend yield coming out. And we don't want you just simply chasing that yield. So what we do is we clear a lot of that noise out of the way as well. And we come in, we have a thing called the DRIP watch lists. And what does that mean? Well, in our viewers page here in the VectorVest program, we have a series of watch lists, and the DRIP stands for the Dividend Reinvestment Program, where you can automatically reinvest your dividends if you choose to. You don't have to. It's a great way to compound the dividends and grow them even more. But we have a list here. We usually just go straight to the top of the heap here and go to the DRIP 25 plus years. What does that mean? Well, all of these companies have a dividend reinvestment plan, and they're what most folks will call the dividend aristocrats. And that means that the 124 stocks found on this list have not only paid a dividend for 25 years or more, but they've actually grown that dividend for more than 25 years. Very big difference in the two. They've not just paid them, but they've grown them every year over the past at least 25 years. We do have stocks for 10 to 24 years, and then even from 5 to 9 years that they've grown those. And you'll see the type of companies that come up here. Mostly very recognizable companies. A.O. Smith is a great stock that I own. Caterpillar's here, Aflac, very recognizable names here that you see. Lowe's is an example. Okay, so what I want to do is come to an example on a graph here of Lowe's. This right here is a 10-year look back at Lowe's. Down at the bottom, this is not earnings per share as we showed earlier. This is the dividend payout. And as you can see, Lowe's has got that nice graph pattern moving lower left to upper right. And not only that, you see how they've grown their dividend payout each year. That staircase goes higher and higher. These are the kind of stocks, dividend paying stocks, that we want in our portfolio, right? We want that company that's continuing to not only pay them, but to grow them. So while dividends may seem a small portion of the income you'll be getting, the steady cash flow and the power of compounding when you reinvest can be amazing. When you do this over an entire portfolio and over time. Compounding is an amazing thing. Okay, this is one of the searches that we use. It's called our blue chip dividend payers, just to give you an idea. It's as basic as can be. The stock watch list, I was looking for just industrials, transports, or utilities from the Dow Jones or S&P 500 stocks. To make the list, they've got to have a dividend yield at the time of the search of at least 3%, and they have to show up on either the 10 to 24 watch list or the 25 plus. And then finally, we have another proprietary indicator in the program called dividend safety. This is the kind of thing those other sources that I scroll through don't give you. Dividend safety is an important concept because what it does in our program, this is the one indicator it's not on a 0 to 2, it's a 0 to 99 scale. And we want it to be at least 50 or higher, the dividend safety rating. Why is that important? Because what we don't want to do, what you'll find on most of those high yielding stocks is when you begin to analyze a little deeper, you'll see that their earnings yield may often be greater than their dividend yield. or that their earnings per share may be greater than the dividend that they actually pay out, the dollar amount. And that's not a recipe for a long lasting growing dividend payout, right? If they're paying out more than they're earning, whether it's the yield or the actual dollar amount, we want to be aware of that. So what happens when we just throw this dividend safety indicator on here, it ensures that that dividend payout ratio is favorable. Instead of going in and having to check all that information, dividend safety makes it very, very easy for us. So we have a portfolio. This one has been about 6 years running now. The number you see here at 78%, that is the capital appreciation. That does not include the dividends that were paid. So you're looking at just about an 80% return just on the stocks themselves. However, when we add, and as of February the 11th, right down to the penny, I've got them added in here, another $27,164.19 in dividend payouts, which puts us over that $100,000 mark, which is just roughly just under 20% return per year on a 10-stock portfolio. The thing to take away from this screenshot here is also that this does not include the power of compounding those dividends. Right, so this is just an example of what you can achieve using a search and the discipline in a blue chip dividend payer portfolio. Okay. All right, so that's the dividend side. When we talk about income and provide, remember, it's important to be able to continue to have that steady cash flow. The other way we talked about was dividends, and remember we mentioned covered calls. And here, I want you to liken it to the idea that you want to collect rent on the stocks that you own, right? Stock resides in your portfolio. If it grows, that's great. That's the kind of stock we want, but we can also charge it rent to stay in your portfolio. And we can do that by selling covered calls against the stock. Now, if you think of it this way, if you were moving and you didn't want to sell your old house, let's say you own a house, but you're moving, you're buying a new house, what could you do? Well, if you didn't want to sell it, you could just rent the house out, right? And you can collect income. You can collect rent every month for your house. If you're going to own stocks, you might as well collect rent on them for taking up space in your portfolio. And again, for those who may not be real familiar with covered calls, I'm going to walk through an example. I just want you to think of it this way. There's a quote from a book that we have here that Dr. DeLito had read and showed us, and it's a great quote by a guy who used to work in the options pits. And he breaks down a covered call this way, and he says simply, think of it this way. He says that if you're not selling covered calls against stocks that you own, you are throwing away money. Because there's someone out there who's willing to pay you money today to take your stock away from you at a higher price at a later date, right? There are people out there who are going to pay you to take your stock away at a higher price, right? It's the most clear-cut example or definition that I've ever heard for explaining what a covered call is. Let's take a look at what that means. So we're looking at Dollar General. This is an actual example from two places, my own portfolio and one of the model portfolios that we track here in Retirement Services. So Dollar General is the stock, and let's set up the scenario for you. Okay, let's say either you own or you can do this simultaneously where you buy the stock and then sell the covered call. Okay, you own or you buy 100 shares of Dollar General. And in our scenario that we're going to create here, you buy it at $112. So that's where this line indicates right here. You buy the stock at $112. What you would do is you would go out and you would sell a call option. You would sell a covered call. You're covered because you own the underlying stock. So selling that covered call adds no risk at all to the position that you own, the stock position. And in fact, it minimizes risk because you've now lowered your cost basis on the stock. right? So if you've built a cushion, you've built in a little stop order in there because you took in cash. You got paid, in this case, for one call option or 100 shares, you took in $2.65 or $265 for one contract. So you got paid. Now, from here, we'll look at the what ifs. If the stock goes down, the profits from the call you sold help to minimize losses on your stock position. Right? So if I bought the stock at 112, I took in 265, that makes it what? 109.35. Am I doing that math right? 112 minus $2.65. That's where I own the stock right now. So that builds in that cushion for me. So it minimizes my losses there. Now that's if the stock goes down. If the stock goes sideways, I'm able to profit on the call, the call that I sold. Right? Plus, you can always sell another covered call since you still own the stock. I could buy back the call, or it can expire worthless, and I could just turn around and sell another one. It's just a way to continue to charge rent to Dollar General for living in my portfolio. What happens if the stock goes up? Well, if it goes up, you can make what we call the max profits. You get to keep the premium and the gains in the stock up to your strike price. Right? So remember, I said someone's willing to pay you to take the stock away from you at a higher price. Now, the key there is you can be called away. It's possible that you lose the stock. So it's very important to understand the objectives before you sell covered calls. But again, I'm a strong believer in the idea in your retirement portfolio. As you collect income from dividends, you can greatly enhance that income by selling covered calls and collecting rent on these stocks. Even if the stock goes up, you still make money. So in this situation, the results of this particular case study, at expiration, Dollar General actually closed at $119. So you would have made $300 in the capital appreciation. That's from the 112 purchase price up to the 115 strike price, where they would call away your stock. Right? So you made those $3, plus you kept the $265 premium that was paid to you. Right? So your total gain here is $565. And I know before you type it in, you're going to say, okay, well, the stock went up and I could have made more money, but that's fine. That's where it comes to the objectives, right? Remember, the objective of the trade is to generate income. Now you're talking about roughly a 30 to 45 day period here. So you're getting that return, which is what, roughly just under a 6% return on investment, 5% and change in less than 30 to 45 days, depending on the expiration that we choose. Right? Do that over and over throughout the course of a year on several different stocks, and that money starts to compound and that income begins to grow even more. Okay. So that's our covered call. So a lot of investors focus solely on capital appreciation, which should be one source of growing your money, of course, and we talked about that. We've talked about dividends. When you start to collect those safe, nice, steady dividends that are continuing to grow, you're generating even more income. And then finally, we talked about selling options, covered calls, right? It's not meant, if you're not an options trader or if you're not familiar with options, you don't have to be a master option trader to understand the concept of selling a covered call or buying a protective put. I want to show an example of the power of all this. Now, I want you to look at this chart as I walk through. It's DHR is the name of the stock. Yeah, it's an old slide, but the concepts don't change. So consider it ABC stock in the current day. This is not important. What I want you to follow is, as we move through this stock, first of all, we're talking about a stock at that time that had a relative safety number of 1.47. I just want to show the power of how this accumulates when you do this the right way. We're looking at 1 year, and in this case, it's 2015. You own DHR. For that year, had you bought and held the stock through the end, you'd have 6.4% return. You owned it here, and at the end of the year, it would be trading here. Now, not only that, but DHR pays a dividend. If you were to hold it for the whole year, you would have received 4 payouts. Now, the DHR dividends was $54 was the annual dividend, so you'd get a quarter of that each quarter, right? So you get 4 dividend payouts. Okay. Now, let's add on the covered call strategies here. So on 113, if I own the stock, I could go out and sell 1 covered call against DHR. For the sake of our illustration here, we're just going to use a 90 strike. I'm not going to get too deep into all the exact mechanics here, but you would go out and you could sell a 90 strike option and take in $70. Consider that as a dividend payout or an income or a payday for you, right? The stock did not go to $90. It did not cross through there, so you were not called away. The stock kind of moved sideways, but you were able to collect dividends and the covered call money. What could you do? Well, you'd go out and sell another covered call. On March 23rd, you could have gone out, sold another call, taken in another $143. While the stock did touch the $90 range, it wasn't called away. We still own the stock. It's still moving sideways at this point, but we got paid again, another dividend and a covered call paycheck. We did the same thing, another $123. And then finally on 9/18, we did it one more time. Another $210 paid to us on a stock that's moved mostly sideways. Now the stock did trade above 90 during the life of that option, but without going into too much detail, it would not have been called away because that wasn't at expiration, and that's not far enough ahead of that strike to be called away. So you would not have been called away at this point. You would, however, on this option sold, have been called away at expiration here because the stock did move higher. I mean, it didn't skyrocket. It went up to hit a high of around $97 or so, and then pulled back. So what were we just able to accomplish there? Well, if you look at the life of that trade for this one stock, had we just held it, we would have taken in a capital appreciation of $551, right? If we had sold the calls, because it would have been called away at the $90 range. We added another $41 in dividend payments because we wouldn't have collected that 4th dividend because the stock would have been called away. That's right now a total of $592. And then with the options that we sold, we were able to take in another $546. So we were able to earn over $1,000 on that 100 share position of DHR. Let's compare that. If we had just held it, $551 would have been the capital appreciation versus a total of $1,015 when you take into account the dividends and the capital appreciation along with the power of selling the covered calls. So I'll ask, would you want just the growth side of that with no additional income? Or would you be more happy with growth and income by using the dividend and option concepts here? So growth or no growth? Or, I'm sorry, growth only or growth with dividend and options? Growth and income, Tamara says. Yes, growth and income is what we want to look for. Growth and income, right, Jay? And Paul? Yeah. So it's a very important concept to be able to add to those positions there. Finally, I want to walk through again what I believe is the most important concept here. That I believe the most important thing to take away from here is that we're going to focus on protecting your portfolio, right? I took the oath a long time ago to protect and serve, and I've kind of carried it forward into helping to build and manage retirement portfolio. I want to protect your portfolio, protecting and serving. All right, so protective puts is what we're talking about, and we title this Protect Your Assets. You always want to be thinking about making money, but I learned a long time ago when my first goal was not to lose money, making money became a whole lot easier. So we talked about how to do that. Now we need to think about this management side, right? The protection of our portfolio. Think of it as insurance. That's all it is. You want to make sure that your portfolio and your stocks are protected just in case they start to fall. And today I want to focus on using an option trade called a put option to be used as insurance or protection. I'll say it again. You don't have to be an options trader, master the vernacular. You don't have to be an expert to understand the power of a covered call or a protective put. If you own car insurance, life insurance, homeowners insurance, heck, we even got insurance on our 2 dogs, right? Then you understand the concept I'm about to walk through. I'm going to set up a scenario. Texas Instruments is our underlying stock here. And let's say you really wanted to be defensive on Texas Instruments, right? Maybe the market is topping out. Maybe you're uncomfortable with the current market condition. Maybe there's an earnings report coming out, whatever it might be. You want to be defensive. You would go ahead and buy a put option. The price of the put or your insurance policy depends on where you set what's called the strike price. So with the stock trading up around this level, we'll call it, I don't know, 118, 120, somewhere around that number there on this particular date, I could buy a strike price of 120. That would be an insurance policy with no deductible, right? Would be at the money. So the analogy that I use, you'd have no deductible. You're paying more for the insurance policy, but you don't have any out-of-pocket expense. It's kind of the way we look at it. If you want to go out of the money with the stock trading somewhere around 118 to 120, somewhere in that range, I could pay a little less money and buy the 115 strike. Now here, I would have that deductible of roughly $3 or $4, whatever the price would be, right? But anything below that, I would be covered, theoretically down to 0. So let's look at a case study here. You bought Texas Instruments on 11/24. This would be 2017. Why? Because that's a signal for our confirmed up call. Nice quality stock, good company. You bought the stock and everything did exactly what it was supposed to do. The stock took off nicely. You got a nice unrealized gain. On January 17th, you have a gain of roughly 20%, which in this case was about $2,000. Because we do our due diligence on every stock we own, we know that about a week from that date, earnings are to be announced. Doesn't mean we go dump our stock. We don't want to turn it into a trading account, but it just means I need to be proactive. I want to protect those gains. So let's set the scenario up where I went out and I bought that at the money put option. And it cost me $423 to protect an asset, which is at that point was worth probably close to $12,000. Okay, that's the scenario. What happens? A week later, Texas Instruments announce earnings and the stock gaps down. What happens is your put increases in value, offsetting the losses on the stock. So you bought the put at $4.23 a share, or $423. The value of that put at the close of trading, the very day earnings were announced, is now $1,128. The value of your put rises when the value of the underlying stock falls. That's a put option. It gives you the right to sell your stock at a certain price by a certain date. So you now have the right to sell 100 shares of Texas Instruments at $120 when it's trading down here at roughly 109 and change. But we wouldn't do that. We would just go ahead and sell the option and pocket the premium or pocket the profit. So here's the setup. Here's what just happened. Had you not bought insurance, had you not been proactive, the gains on Texas Instruments before earnings was $2,000 total unrealized gain. Because it's incumbent upon you to be proactive and protect that, right? After that, if you were not, you lost half of it. Now, you still had a gain in the stock from where you bought it, and that's wonderful. But this is not. Doing nothing and watching half of your profits disappear is unacceptable. So, $1,000 of your profits gone had you not bought insurance. However, had you bought insurance, your $2,000 would now be down to only losing $300, right? So your value of the stock is at 1,000. However, the value of that put option, the profit, is now $700, which means our gains after the earnings report are at $1,700. So what did we just do? We just mitigated fairly dramatically the loss or the drawdown that we would have experienced. Remember earlier on I showed that portfolio equity curve, and we saw from October to December that big drawdown, right? That pretty violent drawdown. Well, that's what happens when you don't do anything to protect your portfolio. Here, all we did was go out and buy a put option. If we chose to, we can continue to hold on to the stock, or you could sell the stock. That would be up to you. But at this point, you've more than cut in half that drawdown that you would have had, right? So you only lost $300 instead of $1,000. Now think about that throughout the course of a year, being able to mitigate those drawdowns, right? And not having to wait for stocks or other stocks to come back just to make up, just to get back to where you were when that drawdown began in the market. So we drastically minimized our losses. Here's an example. Elaine gave us the permission to go ahead and use an example here. And, I do what I do because of things like this, right? And Elaine said, because we taught about hedging the portfolio. This is going back to early January. If you remember, the market took a hit in early January. And we have a process buying put options on the SPY. That's the ETF that tracks the S&P 500. It saved a large portion of his portfolio. He put $835 into this insurance policy and sold my puts on February 6th for over $23,000. Okay, that's an extreme example, but that's what, it's why I come to work, when I can see things like that. Okay, that's an insurance policy that saved a portfolio during a tough time. So I'll ask you, again, I think I know the answer. Type in either protection or no protection. Protection, of course. Like I said, I know the answer. Paul, Bill, Artie, Don, everybody's typing in. Yeah, we'd rather have protection on this. So again, one of the shifts you need to make to allow you to retire with peace of mind, which is our ultimate goal here, is going from having no method of protection to having a way to protect and preserve your hard-earned capital. So protection is, to me, the biggest reason, the biggest necessity to retiring with peace of mind, is understanding how to apply that. So I said at the beginning that I wanted to show you how to get a retirement that gives you peace of mind. And to do that, we focus on the way you profit, provide, and preserve in your retirement portfolio. Now, at the beginning, you gave yourself check marks next to the things that you're currently doing well. You put an X or a frowny face next to the things that didn't get you there. The more check marks that you had, or the more positives that you had, the easier it'll be for you. Today, we talked about 3 core strategies that we need. Buy good, safe stocks, use dividends and covered calls for income, and understand the power of a protective put option as insurance. Now, it's been my experience over the years that if you are able to follow with the proper discipline that setup, that you'll be able to profit using a growth portfolio focused on high safety stocks. You'll be able to provide income using a combination of dividends and covered calls. And you'll be able to preserve your capital so that you know your hard-earned money is kept safe by mitigating those violent drawdowns. So at the beginning, again, I said I'd show you where to go to get more help, and I'd like to do that now. To help you get the results you're looking for faster, we put together a 6-week course that gives you heaps more detail than I just went into. Even though we went, I think, over a lot today, we only scratched the surface. This course goes a whole lot deeper on the topics we discussed here. Plus, it discusses some of the topics we didn't even have time for here today. It's called the Ultimate Retirement Solution Online Course. It's designed to take you by the hand. We're going to guide you through the method that you need to grow and protect your retirement account. so that you can meet that goal we talked about earlier, again, of retiring with peace of mind. That's our ultimate goal. There are 6 modules, and the best thing that we've found to do is kind of break it down for you module by module so you know exactly what you're going to get. The first module we call Win Before You Begin. This is where you'll get very clear on your objectives, and I couldn't be more urge you more to understand that before you encounter on this building and managing your retirement portfolio, you have to have objectives. You have to have a plan, and you have to be able to map that out, that strategic plan, to accomplish the objectives. So in this module, we define those objectives, we talk about portfolio allocation, and we set clear goals for you to achieve. So there are three main strategies that we'll use. In order for your portfolio to steadily grow, you need to fill it with the right stocks, the way we talked about earlier in our 1927 Yankees picture. In module 2, we're going to show you how to complete the first of the 3 Ps, right? And that is profit. You'll learn how to quickly find and identify safe stocks, the right time to add them to your portfolio, and we'll even talk about the exit strategies and the right stops for you to manage the portfolio once you have it built. In module 3, we'll talk about the same concept, but this time about building your dividend portfolio. We talked about every little bit of extra income is going to matter in your retirement years, and dividends are something every retiree should be taking advantage of. So in this module, we begin filling in the second P, which is the provide, so that you can begin to turn on the tap for that additional income. You're going to learn what makes a quality dividend stock, how to quickly find those great dividend stock payers, and how to set the right stops again for this. Because the way we manage the portfolios and these different strategies that we employ are going to be a little different. So we're going to talk all about that in module 3 on the dividend portfolio side. Module 4, we're going to continue that idea of creating your income stream. We believe that every retiree needs an additional source of steady, reliable income. Banks, bonds, Social Security, you can have them out there, but they're not always going to be enough. They're not always going to generate that steady income at the same rate. So in this module, in module 4, we'll fill in the rest of the second P under provide so that you have multiple sources of additional income. Here, you're going to learn what a covered call is. We're going to go into greater detail, how it works. Even if you've never traded options before, or never sold a covered call, if you have never sold a covered call or used a protective put, then this is the course for you. This is where you have to learn. Again, in my opinion, it's not a luxury to know these. It's not something you should know. If you're managing and building your own retirement portfolio, you must have this information and ability to do this. And the same for the strategic defense. You have to be prepared to know what to do. A lot of people don't have a plan for when the market goes against them like it did in October. You don't want to just sit there and worry about what could happen. You need to take control of the situation. You need to be proactive. And this module will complete the third P in module 5, which is preserve, so that you know how to protect and defend your capital and have that plan in place that allows you to sleep soundly at night. Knowing your hard-earned money is safe. That's what peace of mind, right? It's the definition of peace of mind. There's only one way to wake up in the morning and know that you're protected in your portfolio. The only trade I know of that makes it truly worry-free is understanding the protective put. And that's what we'll do here in module 5. And the big key to module 5 also is to show you those strategic times when you need to become defensive, what to look for, and the best techniques that you can use in those situations. Right? That's a big key. You don't want to just always be out just spending money on put options when you don't need them. Right? There are very strategic times to make sure that these are placed, and that's what we'll walk through. Finally, we're going to talk about implementing your plan in module 6. Education is great, and understanding all the theoretical aspects of this is wonderful, but implementation is what it's all about. In module 6, we're going to take all of the things that you learned and show you how to put the 3 Ps into practice. right? How do I actually implement all of those things I just talked about? We're going to show you how to build and manage your retirement growth portfolio. We're going to show you how to set up an income portfolio for consistent monthly income. We're going to provide you with step-by-step checklists so that you manage your portfolio confidently. Okay, that's what the 6-week course is going to allow you to do, to build that entire trading plan. I don't even call it trading, an investment plan for you to put into place, and not just build, not just find the right stocks, although that's extremely important. We're going to manage that portfolio once we've done that, and that's the key. As an added bonus, what you're going to get if you sign up, you'll also get 6 live mastery support sessions. Here we have the modules, and then the same week we're going to also have a mastery session, kind of a Q&A session, where we can go through, help you implement what you've learned, look at what you're doing, help to guide you in these mastery support sessions. And don't worry, the same as the modules, the mastery support sessions, all of this is recorded. Okay, you can submit questions and you can watch the recording if you're not able to make any of the mastery sessions. But we found these mastery sessions are extremely helpful so that you just don't watch we'll have it live presentation. You could watch the recording of the module, but to go in and take that second effort to go in and actually dig deeper and make sure that the implementation and understanding of the techniques are in place. So very powerful part of the course are the mastery support sessions. Another added bonus, you're going to get 6 weeks access to what we call the Ultimate Retirement Solution coaching class. Okay, it's a weekly retirement session that I conduct every Tuesday, and you will be invited for the length of the course. We go through retirement portfolios, like I was just showing some of the examples, our weekly retirement portfolio updates. We go through, does a company have earnings coming up? Should I be selling covered calls here? Do I need to place a strategic protective put option based on either the market or headlines or an earnings report? Right, so we actually look at real-time data and what's actually happening. We'll also every week walk through a weekly covered call income trade, right? What we used to call years ago the payday portfolio. We have a process where we walk through each week and get paid by doing what's called a buy rate. So we'll walk through that weekly income trade for you on the covered call. We'll walk through the steps of how you can find the best candidates and some of the rules that go with that. Now, if you are in the room here and you are new to VectorVest or have not used VectorVest, or currently are not, we're going to give you 60 days access to the program. We believe it's the very best tool to determine market direction and find the type of stocks that we're talking about. It will dramatically reduce the amount of time you spend. Think of the gentleman out in Denver. I call him the weary investor, right? The guy who spent all that time finding high RS stocks when all he had to do was click on ruler stocks. Think of that guy. When you have VectorVest in front of you and you're able, with just a few clicks, find that information. We're going to give you 60 days access to that. If you order before the end of the webinar today, instead of paying the $695 that the course, our early bird pricing is, you can get it instead for just $595. That means that you're going to get the full course. You get 1 full year's access to the recordings of the course, including the 6 live mastery sessions. You get access to the software and access to the members-only retirement group coaching. Again, that retirement group coaching group that I talked about will be 1 day a week. It'll be every Tuesday at 2 p.m. Eastern time, and we do record them. But that's the one you'll be invited to, and we're going to offer that up through the life of the course as well. So that $595 price will only be for those who register before we finish up here today. So if you go to vectorvest.com/URS, I will walk through that for you. And Brian just went ahead and he did type in that in the chat box, www.vectorvest.com/URS. Okay. I'll walk through that in just a moment. Before I do, I wanted to let you know also that we do offer a money-back guarantee on this course. You can go through the entire course, and if you're not satisfied, you can get all of your money back. We'll give it all back to you. This is a completely no-risk course. We do want you to go through the course, though, and do the work, because we know if you do, you'll see the results and the value of the course. However, if you do go through the course and it's not what you wanted or not what you expected, and you're not satisfied, we will gladly refund your payment. The question that I like to ask here is, how much is it costing you not to do this? Right? Are you running into those frustrations when the market turns against you, the generating of income is not where you need it or want it to be, that you're worried about, again, that peace of mind when you retire? When you look at it that way, what's it costing not to be doing this is a question I like to ask. And the other question when it comes to retirement, especially retirement, is, the old saying, when is the best time to plant an oak tree? And they say it's 20 years ago. What's the second best time to do that? Well, we say it's today, right? So again, whether you're approaching retirement, you're in retirement, your retirement years, these are things that are going to be important for you. It's never too late to begin to implement these plans and take control so that you can get that peace of mind that we talk about. Okay. So again, order before the end of the webinar. The $695 will slash that by $100. You'll pay only $595. If you are an elite member, if you're an elite subscriber, go ahead and call 888-658-7638. And our elite subscribers do get that price. $497.50 will be the price for elite members. You do have to call 888-658-7638. Okay, and Brian also typed in there as well, so that information is there. Remember, it's 6 modules. They'll be conducted live, and then they will also be recorded, and the mastery sessions will also be live, and they'll be recorded as well. When you go to VectorVest.com URS, you'll come to the registration page. You'll see the Buy Now bonus limited time offer is $595. That's during the webinar. In just a moment, I'm going to start a Q&A session, answer any and all questions that you might have about the course. There's no discount code needed. Just go ahead and go to the website here and make sure Buy Now bonus is checked. Make sure you enter in your pertinent information here, and you'll be set to go. So the Ultimate Retirement Solution, the regular price on this course is $995. Our early bird special, what we call the early bird, if you sign up early, you will get $695. That offer ends on Monday, February 25th at 5 p.m. Eastern Time. Again, elite members, you will receive the $497.50. Just give a call. And here's a quick summary for the dates and times. This is February 27th. The course begins. We'll go every Wednesday at 4:30 p.m. for 6 weeks, starting February 27th. And our mastery sessions will be held every Monday at noon. So the markets will be open. We can actually look at what's going on in the current market and walk through all of the important aspects of each module. So again, order before the end of the webinar, save $100. Go to VectorVest.com/URS. Okay. And with that, I am going to ask my colleague, Mr. Brian D'Amico, if he will enter in with us, and we'll start a Q&A session here, and we'll talk about any questions that you guys have on anything that we showed here and anything that we can help with. Brian, are you there?
Hey, Jim, can you hear me all right?
I can.
All right, cool stuff. Mr. Robinson in the chat box typed in, said, this was time well spent. Thank you very much, Jim. He said, he says, I understand it much more now. So that's a cool feedback.
Good to hear.
All right. By the way, if you guys are ready to, if you know you're joining and you're in, can you just in the chat box let us know? Just type in like I'm in, and was, we always like to know who's, get to know some of the names, and we can't see your face, but get to know some of the names of the people who are going to be joining the class, so we can say welcome. So in the chat box, just type "I'm in," 2 words, and that way we can say welcome aboard. And while you're doing that, it looks like, Jim, you covered kind of the most common question that I saw in the chat box, which were some of the dates and the times. Now, what if somebody is, of course, when there's a live class like this, that's over a period of 6 weeks or so, what if someone's fearing, like, man, what if I miss a session? What would you say to them?
Yeah, no, that's a great question, because a lot of folks will ask that, not always able to get into the live session. But all of the sessions that I talked about, starting with the live course modules, they will be recorded, and they will be available in the service called Digital Chalk. So you're going to have the ability to watch the recordings for all of the modules, as well as the mastery sessions. Those 2 are all recorded and available to you if you cannot make the live session.
All right. And we have a few, some people saying, I'm in. So we have Michael. Welcome aboard, Michael. Cheng, welcome. Dell says, I'm in. I won a drawing back in January. And so, he's Dell's in. Anne is in. Muhammad is in. Bill is in. Welcome to all of you who are typing in I'm in. You should be getting an email virtually instantaneously. So check your email. There actually should have been a page that showed up right immediately with all the dates, all the times, all the information. But you should also get an email. So check, if you don't see it in your inbox, check your junk or your spam folder. Be sure to check that, because it's going to have, like I said, all the dates, all the times. It'll have the link to the digital course. It'll have that private email address where you can start sending questions. And if you feel you're going to miss a class, you could always send in questions to that private email address. You could also use that email address throughout the week. You don't have to wait for when the live session is coming up. So check your email. Welcome aboard to all of you who are typing in I'm in. It's great to have you with us. Jim, next question for you.
Yes.
Now, you mentioned that I think there's a slide, or probably a couple of slides, that showed something about elite status, and there's a couple of people who are not sure. They're like, what is an elite member? What is that all about? Maybe what is an elite member?
Yeah, that's a great question. An elite member is someone, the rules to become an elite member are if you've been with us for at least 5 years or have spent at least, I believe it's $5,000 with VectorVest. Once you reach those levels, you become what we refer to as an elite subscriber. If you're not sure, if you believe that you may be an elite subscriber, you can certainly give our product support a call at that number on the other slide. It was. Let's go back, and you can determine that and make sure. But an elite subscriber is someone who's spent a certain amount of money, 5,000, or has been with us for at least 5 years. That's the definition of an elite subscriber.
Awesome. There's some questions from people who are saying, not from people, from a person, wondering if the strategies that you're teaching, I'm trying to find the name of the person, Michael said, can all these procedures and things that you teach be done in an IRA account?
They can, Michael. There are very few, if any, mainstream brokerages where you might have an IRA account that they're all going to allow you to sell covered calls, and they're all going to allow you to buy protective puts. So I'd be very, very surprised if your IRA is with a broker that would not allow you to do that. There are some option trades that some brokerages get a little more tighter with their restrictions, but to buy a protective put, to sell covered calls, they will allow you to do that in 99% of IRA accounts.
All right. Now, Jim, I see somebody here from the UK. So first off, welcome all the way from the UK. They wanted to know, is this the strategies that you teach, can they be applicable? Maybe not can some of them or all of them or maybe just some be applicable to other regions, or is it strictly like a U.S. thing?
Now, I think they can be applied in any market. That there is a difference, though. So as far as the stock analysis goes and finding the right stocks, safe stocks, regardless of the market you're in, that's always going to work for you. The only difference may come in some markets. The options markets are a little less liquid. The option trades and premium for selling covered calls may not always be as liquid as the U.S. market. However, if you're buying well-known companies that do trade options in whatever market you're in, because of the quality and the size of the companies we're usually looking at, you should be able to find some that will certainly work there. So the short answer is yes. The only side of that I'll put one little caveat in is sometimes on the option side, some stocks could be a little less liquid. But as far as the stock analysis and building the growth side of the portfolio as well as dividends, you can certainly apply those in any market that you're in.
All right. And I answered one in the chat box. It was from Bill, who's saying, if I can't make it to the Wednesday session, will I have access to the replays? Yes, definitely, Bill. You probably heard Jim mention that earlier. Everything is recorded. Since this is the first time we are running this class over a 6-week course, if the class is on a Wednesday, you'll need to give us about 24 to 48 hours to, edit the recording. That way we kind of get rid of some of the, there's some stuff at the beginning and some at the end. Just we want to make it a nice, clean recording for you. So give us about 24 to 48 hours to get it all uploaded for you. But yes, definitely the recordings will be made available to you as soon as possible, within 24 to 48 hours. All right. Next up, we answered this one on elites, and I see a question in here. We already answered John Quill's question about the UK, so I'll skip past that one. John Key, and there was one other person was asking, all right, you mentioned if I'm not a VectorVest member, there's VectorVest software, and they were wondering, how much. Well, there's two questions. How much is VectorVest? And maybe those people who don't have VectorVest right now, they're wondering, the stuff that you teach them, Jim, will it benefit them even if they don't have VectorVest?
Yes, the answer to that is yes. Regardless of the source that you use to apply the techniques, the concepts that we use, the concepts are the key, right? And what I'll do is I'll just answer that referring back to the analogy, or not analogy, but to the story I told about the gentleman at the seminar, right? He went out and found stocks that were in that ruler stock search. He found 6 or 7 high quality, high RS stocks, but it was to the point where I actually, was worried about his health. he was, like he hadn't slept in days, and he was very on edge, and it took him a long time, and it was very frustrating for him. So the point of that story is that the short answer is yes, you can, but VectorVest makes it so much easier. Picture yourself going through a list of dividend paying stocks, not only finding good quality yields, but also looking for good quality stocks, not just the high yields. And then try to sit through a list of stocks and determine, is that payout ratio favorable to me or not? And going through each and every one of those stocks. And then looking at graphs to make sure the earnings per share not only is where it is now, but it's been growing, as well as the dividend. And so while the answer is yes, you can, VectorVest just makes it so much easier and so much less time consuming.
All right, and Bob and Janky were asking about the costs, and I mean it ranges. I mean, there's different versions of VectorVest. The lowest, we have an end of day version. If you decide to stick with VectorVest, it's like, what is it, Jim? $69 a month, I think. And
I believe it is. Yep.
So I love that example that you give about someone who's they spent like, I don't know how many hours that gentleman spent trying to find those stocks. And
Too many.
Yeah, I guess that's a good answer. Too many. And then you just click a button and they were all there. All right. So that was for you. I think it was Bill, because you were asking about the price and the cost afterwards. So let me just be clear. I mean, you're not locked into contracts, so there's no cost afterwards If you choose to continue with VectorVest, which again, it's your choice. If you choose to continue, the lowest cost version of VectorVest is $69 a month. But the things that Jim is going to teach you can still benefit you whether you use it or not. Hopefully, you'll see during the course that, saving hours and hours of your life might be worth something to you. But either way, you could make that decision during the course. And remember, there's that money back guarantee. If you find towards the end of the course, you're like, you know what, I want my money back. That's available to you. We don't have a lot of people taking advantage of that because the course is pretty darn good. All right, so remember folks, if we didn't call out your name, I might have missed it. If you're in the chat box, just type in "I'm in," and we'd love to welcome you to the group.
I see Kathy from San Diego has typed in, Brian. She's in.
Awesome. Welcome, Kathy. All right. Now, I'm not sure. It seems like we have a lot of people from overseas. We had some people from South Africa and UK. Richard wanted to know, is there anything in the UK that's equivalent to that watch list that you set up? You showed that drip watch list. Is there anything that you know of in the UK for that?
Oh boy, I'm not 100% sure if they have those in their viewers tab. Couple of things. First of all, you can search for those stocks and create a watch list, but you can go into the viewers tab if there's a folder for dividend payers. I apologize. I'm not 100% sure if there's a drip watch list on the UK where they reinvest the dividends.
But even if they don't have the dividend reinvestment plan, they could just look for stocks that have high dividend safety or something.
Yes, you certainly can. And even if you don't have that pre-built watch list there, the beauty of the power of the VectorVest program in the Unisearch tool, the search engine, is that you can go create your own watch list. You can find stocks that meet certain parameters, kind of like I showed on the blue chip dividend pair. Stocks with high high relative safety, also a high dividend safety, and some of our other proprietary indicators. So you have the ability to do that in the VectorVest program.
All right. So I got this. I'm just going to go in order now, just to keep my sanity of the questions that are coming in. But I did want to welcome aboard. William says, I'm in. Peter says, I'm in. I'm an elite member, and I'm going to call that number. So welcome to both of you. Remember to check your email for all the details for the course. I'm gonna go out of order and then go back in order, Jim, because Bill's is funny. He says, Jim, do you offer any guarantees that my wife and I, if we do this together, that we're going to stay married?
There's so many things going through my head. I have to be careful what I say. I do. How long? I don't know. How long have you guys been married? This will not be the cause of you no longer being married. How about that?
Wow, 42 years. Well, congrats, Bill, on that.
Congrats. That's great. Yeah, this will not cause 42 years to go away. I guarantee. Yeah. I can almost guarantee that.
Hopefully, it'll be allow them to have a better retirement. And now, if they don't like spending time together in retirement, that might cause an issue.
Bill, you just do what she tells you to do, and everything will be fine.
All right, let's see. Now I'm going to go in order. All right, this one's from Arnold. And I'm not sure I fully understand what he's asking. Let's see. He says, where do I find what the covered call and put costs are located? They're pretty much just with their broker, Jim?
Yeah, in our examples, we put some numbers up there, but you would find it's called an option chain, where you would get quotes for options. There's different expiration dates for every option. There's what's called different strike prices for options. All of that information is found on what's called an options chain. So all of just like, remember, an option trades just like a stock, right? There is a bid price, there's an offer or an asking price. There are market makers who provide a fair and orderly market. So options really do trade just like a stock as far as the actual mechanics of trading them. And the options chain is where you would find the pricing of those options.
All right, cool. Oh, and remember, folks, if you're not an elite member, this $595 price is only available while we're on this webinar here. So as soon as we're done with the last handful of questions here, that $5.95 price will go away. It'll go back. It'll go to $6.95, and then that $6.95 rate is only good for a few days, and then it's going to go to $9.95. All right, so that I believe that's good until like Monday or Tuesday. I think is it Monday night, Jim, or is it Tuesday? One of those days.
Monday at 5 p.m.
Okay, thank you, Jim. So time is of the essence. All right, next up, Bob wanted to know how often do you run the class? Now, so I'm not sure which class he's referring to. So there's this course, which we haven't set in stone, right, Jim? It might be once a quarter, but we don't know when the next. I don't know when the next date is for this. Do you?
I do not know. I mean, I guess there's a rough outline, but as we speak, I do not know exactly when this course will be offered again.
All right, and then the second thing, if you're referring to Jim's bonus session that you get, he does those every Tuesday. All right, so this course is done on Wednesdays and Mondays, I believe, Jim, right?
That is correct.
And then the bonus sessions that Jim offers are on Tuesdays. Oh wow! If you flip back and forth fast enough, they show up on the screen at the same time. It was like fading in and out. It was kind of cool.
My mouse is very sensitive. That's why I scroll through too quickly here. But yeah, again, remember the class starts on. This is February the 27th. This first one, and then it's going to be each Wednesday after, and then Mondays are the masteries at noon, so the market will be open, and then again, just to reiterate that, on Tuesdays at 2 p.m. Eastern time, we have our URS group retirement coaching that you'll be invited to.
All right, and I just read the second part of your question, Bob, that you have a credit on your account, like a certificate. For that, I believe you need to call. So I don't think you should use that link, that phone number that Jim had on there. I'll put it in the chat box as well, 888-658-7638. Just give our team a call. Oop. There you go.
I got to scroll all the way back down.
There we go. So I put the phone number in the chat box there, Bob. Next up, let's see. Don, I know you had to step out, but I'm going to try to answer your question here. You said you have a MacBook Air. Can you use the abbreviated VectorVest version to manage your portfolio? Now, when he says the abbreviated version, so you might be talking about VectorVest Basic, but there's also the VectorVest app. Now, Jim, to your knowledge, can somebody still, if they still want to use VectorVest, can they still get by, let's say, using either one of those?
I think that you can, because remember that we're looking for a very specific type of stock, and it doesn't really go so deeply into this idea of 15 different parameters to find a stock that has a high relative safety number. So searches like ruler stocks and some of the others that we use are pretty straightforward. And so yes, I think you can use any VectorVest program to help you find the stocks. Did I mute you, Brian, or did you mute?
Oh, there we go. Can you hear me now?
I can, yeah.
All right. I think that happens with my big belly. I hit the mute button on the.
I do it all the time. Yeah.
So I'm not sure if you heard me thank Kathy. But Kathy let me know that the program is called VectorVest Express. For some reason, I was calling it VectorVest Basic. So thank you, Kathy, for that. And somebody had, I think it was Bill, had typed in that he's in. So welcome aboard, Bill. Bob had typed in. He said, "Thanks, Jim. This makes a lot of sense." He says, "Good job." And let's see. Next up, Peter wants to know: do you need not just VectorVest? He wants to know if you need to have any extra VectorVest add-on modules to do the stuff that you're talking about here.
You don't need any add-ons to what we already have. Again, it's kind of the same answer as before. You know, all of the techniques, the objectives, the concepts that we're going to go through, VectorVest will make it easier. There are add-ons that are even more helpful, but none of them that I would stand here and say that you need to add this add-on to be able to be successful in what we're going to teach you. So no, there's nothing that you need as an add-on here.
All right, we just have a handful left. This one looks to be from Frankie. Frankie says, this is Frankie. Well, hello, Frankie. He says, I recently canceled my membership, but you guys offered me an extension month for free. So like you're back on a trial for a month. And you say, but if I'm interested in your course, what rate will I have to pay? Well, the rate is for everybody is like $5.95. Right? Unless you're an elite member, but it doesn't sound like you're listed as an elite member. We should have canceled your account. So your rate, Frankie, would be $5.95. And I think what our team would do is if you just started your 1 month trial, is that they would line up that trial and give you the 60 days. So that you would basically have the time to go along with the course. All right. Now, that being said, Frankie, if that 1 month trial is just about to end, like this week, you should call. Like call the team, and they could be able to figure out the dates for you. All right. I think did you want to answer Cameron in the chat, Jim? I saw you were typing back to Cameron, or did you want to just respond verbally?
No, I'd like to respond to Cameron. Cameron, sorry, we were just hitting some of those others that were just coming in order, but I did want to respond to Cameron's question because Cameron wrote that I have taken both of the option courses already. So his question was, is it necessary for me to take this course, or is it overkill? Right, and he does have the real-time version of the program. Is it overkill? And my answer, Cameron, is here's what I would say to you. The option courses are great. They have very specific objectives. What this course does, as I said earlier, and what I want to be very clear on, we teach 2 option trades, covered call and a protective put. But more importantly than that, what the takeaway and the importance of it is not just what a covered call is and what a protective put is, but more importantly, when to use them, specifically how to use them. And so, you know, it's hard for me to say. I personally, I don't think it would be overkill to take this course if you've got equities and not just option trading. I mean, if you have a portfolio of equities that you're looking to grow and protect, if you've taken the option courses, you know what it is to buy a put. But we have different, you know, we got into much more specifics on exactly when and how. And so, listen, I think it would help you. And just to go back to the idea of the money back guarantee, if you take the course and you go through and you believe it was overkill, then we'll give you your money back. But you know, I don't think so. Only because we go into more specifics on how to use them. It's not all about you know, teaching options. If you've taken both those courses, you know what a covered call is. You know what a protected put is. But we're going to go into much more detail on how and when to apply them. So hopefully that helps.
All right, and remember, we just in the handful of questions we got left, the $5.95 rate is good just for a few more minutes. So if you feel it's right for you, hop on to go to vectorvest.com/URS. You could just click the link in the chat, or if you're an elite member, just give our team a call. All right, so next up is John. I think we just answered that one about needing any extra add-ons. So hopefully that Jim's answer helped you with that. Charles wants to know, how long would you say the webinars are?
They'll range anywhere from 60 to 90 minutes. You know, we at the end of each module, we will have a Q&A specific to that module. So we'll answer questions there. You know, so that can take us a little longer. We stay as long as we have to make sure we answer every question. Same thing in the mastery sessions. We'll take in, you know, anywhere from 60 to 90 minutes to make sure we get through everything we need to.
All right. Charles says, would this course work for a beginner? Because I'm totally green.
Charles, I think so. I mean, when you say totally green, again, you can type in or not type in. Hopefully this will help answer your question. I mean, if you don't own a stock, if you've never invested in the stock market before, listen, I think it can help you. We have other courses that start from the beginning. So not really knowing the definition of totally green, if you've got any experience at all, if you have a brokerage account and you own stocks, then this course will help you, and it would be helpful to you. But if I'm being honest, if you've never owned a stock, there may be places you want to start first. I got to be honest with you. But if you have a brokerage account and you own a stock, and you're looking to grow a portfolio of stocks, then this course will definitely help you.
All right. Michael says, can we watch this, or can we get the seminar on a Mac and a PC? So now there's two things there, Michael. I mean, the course itself you could watch because it's all done via GoToWebinar, like we are doing right now, and the recordings are just videos. All that could be done on a PC or a Mac. It's when it comes to the VectorVest software, if you want to use that, that is a PC-based software. Now, some people run it on their Mac because they installed Windows on their Mac. But yeah, you could watch the seminar, watch all the modules, come to the live sessions on a Mac. It's just the software, the VectorVest software is where it's a little tricky.
Yeah, I have a MacBook and I just set up Parallels and I have Windows on it. It costs a couple of dollars, but just you can do it. You just have to add some software to it.
Yep. All right. Next up, we've got Charles.
Yeah, Brian, I'm gonna comment real quick for Charles again. Charles, if you take the course and it's helpful to you and it helps you to learn how to begin to invest for your retirement portfolio, great. If not, again, we have the money back guarantee. If it's a place for you to get started, that would be great. And then Brian, as far as the other portion of his question, I don't know if we're going to type something in there, but there is the money back guarantee. I don't want to just say no, we can't.